Hello and welcome to RCLCO's June monthly economic update. I'm Scott Bommarito, the Vice President of Research at RCLCO Fund Advisors. And today I'll talk through a couple of the recent developments that we're taking a look at and tracking. I'm sorry to have to start a third consecutive monthly update with the inflation report again, but inflation does remain the key metric that economists are tracking to see how the recent increase in CPI will play out and whether or not it proves to be durable or if it comes back down. So we'll start with the positive silver linings of the inflation report before hitting on some of the less positive numbers. On month-over-month CPI change, we did see some deceleration in May. So that's a positive development as the all items index decelerated to a 0.5% increase month over month, and the core index rose a more modest 0.2%. So this may be an early sign that the recent inflationary wave is already coming down and normalizing again, which was the expectation at the outset. Has been driven mainly by the conflict in Iran, and early predictions were that as that conflict normalized, that inflation would come back into line. So this may be a positive development that is in fact going to play out, and that we'll see this be a very brief spike in inflation. That said, the trailing 3-month numbers are somewhat disconcerting as the all item CPI was up 8.2% on an annualized basis. There will be some natural deceleration built into that next month as the really sharp March uptick in inflation falls out of the trailing 3-month figure. So again, might be a sign that the inflation spike is already coming back down and normalizing again. Also, somewhat more positive development, trailing 3-month core CPI was far more modest at 3.2%, although that is still above the 2 to 2.5% range that's generally believed to be the healthy inflation target. Again, this chart emphasizes the fact that this recent inflation uptick is almost exclusively driven by energy prices. That's a result of the disruptions to the global oil trade as a result of the conflict in Iran. So energy prices overall are up about 24% year over year, and that's trickled through to other energy dependent and energy derivative indices within the CPI. So airline fares, for example, up 27% year over year, and then perhaps the most salient numbers, gasoline prices, which are up 41% year over year. Again, we continue to expect these figures to come down as the conflict resolves, and we expect that to then lead to normalized inflation reports by the end of the year. Elevated inflation has trickled into interest rates as well, pushing interest rates up. So across the yield curve, U.S. Treasury interest rates have risen over the last month. That's most notable in those short-term rates. So the 3-month yield, for example, has increased from about 3.7% a month ago to 3.8, even moving up toward 3.9% more recently. And then longer dated maturities are also up. The 10-year yield has risen up to about 4.5%. That's actually come down somewhat even just this morning as of time of recording to 4.4%, but still remaining in the top half of the range that the 10-year's been in the last handful of months. Looking ahead, the futures markets imply 1 or 2 hikes to the federal funds rate by the end of 2026. Risks are skewed toward more hikes at this point, and interest rate cuts have pretty much come off the table. This is a notable development since coming into 2026, most economists were asking how many rate cuts are we likely to see in 2026. That has since pivoted, and we're now asking how many rate hikes are we likely to see. So this does remain to be seen how many come into effect, although 1 to 2 hikes looks like the most likely scenario, and fewer economists are calling for any cuts in 2026. So inflation is up, interest rates are up, but we'll end on a positive, which is that employment growth is also up. The last couple of months, the job market has shown some signs of revived life. And in May, it posted 172,000 new jobs. That's the third consecutive month of outperforming expectations. So this is positive. This unfortunately also argues against rate cuts. So this does allow the Fed to focus more solely on its price stability mandate as the employment market looks like it's stabilizing again and holding up healthy. We also see that on the unemployment rate, which remained at a healthy 4.3%, and it's pretty much stayed there throughout the year thus far. The labor force participation rate was also steady month over month, but it's dipped fairly meaningfully below its longer term average, and it's down at 61.8%. So this remains a risk to monitor as the labor force participation rate is low, but strong job growth and a healthy unemployment rate bode well for the U.S. labor market. That concludes our June macroeconomic update. Please continue to follow RCLCO for more webinars and updates as we go.